Hello, this is my first accounting class focused on Indian syllabus for students class 9 to class 12 on the topic, namely Bill of Exchange. I will cover this topic in four parts. Part A, Introduction to Bill of Exchange. Part B, Promissory Note. Part C, Actions or situations falling in the scope of Bill of Exchange. And part D is about journal entries associated with Bill of Exchange. Let us begin our topic. To make it easy to understand Bill of Exchange, we will introduce here two characters, Mr. Alex the buyer and Mr. Jim the seller. As the topic signifies, it is about exchange, and that exchange is about transferring goods from one person to another for a price to be paid later. Alex the buyer is interested in buying a TV set. He has two options. Either he buys in cash or by on credit. The problem is that he doesn't have enough cash. For credit, he has several options such as bank loan, credit card, loan from family and friends, installment plan from the seller, or a bill of exchange. A bill of exchange is an instrument for credit. So Alex's personal circumstances dictate that the only viable option for him is to request the seller for a bill of exchange. Let us now look at an actual example how bill of exchange works. Alex the buyer now goes to an electronic shop and meets Jim the seller. He selects a TV set which has a price of USD 1000. He tries to convince Jim the seller to sell the TV set to him on credit, and he will make payment after 3 months. Jim the seller agrees to extend a 3 months credit to Alex the buyer, but suggests to draw a bill of exchange on him to formalize the arrangements to have a legal cover in case Alex the buyer doesn't honor his payment commitment on the due date. Today is 1st Jan 2023 and Jim the seller writes a bill of exchange. He writes city and the country they are in and the date on which the bill of exchange is being made. He then writes text something like this: 3 months after date, pay to Mr. Jim the seller or order a sum of rupees 50,000 only for value received. He then writes his name and address and also the name of the drawee, which is Alex the buyer. He then stamps and signs it. The bill has no legal acceptance at this stage unless it is accepted by the drawee by putting his signature and the date. Now the bill of exchange has legally been created. After looking at an example of how a bill of exchange works, we can now look at actual definition of it. We can talk here about two definitions of bill of exchange. One is a simple or plain definition, and the other is as per Negotiable Act 1881 of India. Bill of exchange can be defined in simple words as a bill of exchange contains an unconditional order to pay a certain amount on an agreed date. The key words here are unconditional order, certain amount, and agreed date that worth your attention. As per Negotiable Act of India, bill of exchange can be defined as an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. Parties to the bill of exchange. Mainly there are two parties to the bill of exchange, a buyer and a seller, but in some cases there can be another party called payee. A payee only becomes a party if a seller or a drawer takes certain actions such as discount it or endorses the bill of exchange in favor of one of his creditors. There are a host of terms used for the first party to the bill of exchange, normally called a seller. but it can also be called debtor, drawer, maker, or payee. Similarly, the other main party to the bill of exchange is the buyer, but it can also be called creditor, drawee, acceptor, or payer. A third party called payee can also exist. Now, what does a seller do? He writes or draws a bill of exchange upon the buyer. He then signs and stamps it. The buyer, on the other hand, accepts the bill of exchange and makes a payment on the due or agreed date. Who does the buyer pay to? He pays to the payee, who can be the person who discounted the bill, or if the drawer endorsed the bill in favor of his creditor, then that creditor becomes the payee. However, normally it's the drawer who is the payee. Bill of exchange has certain features associated with it. For example, it must be in writing. It must contain an unconditional promise to pay. The sum payable must be certain. It must be signed by the maker. It must be payable to a certain person. It should be properly stamped. Bill of exchange provides some very special advantages to both a buyer and a seller. For example, it provides a framework of credit relationship between a seller and a buyer. Since the amount and maturity dates are specifically mentioned in the bill of exchange, it provides certainty of terms and conditions to the parties to the bill of exchange. It is a convenient means of credit, enabling a buyer to buy goods on credit, and a seller can get immediate payment either by discounting or endorsing it. It is a conclusive proof, providing a legal evidence in writing, easy transferability. A debtor or seller can immediately settle his debt by transferring a bill of exchange through endorsement or delivery to one of his own creditors. Please stay tuned for my 3 more videos on the remaining topics of bill of exchange, which include promissory note, different scenarios such as maturity, discounting of bills, etc., and the journal entries. If you found this video useful, please subscribe, share, and like it. Thank you.